A very warm welcome to you all for tonight's discussion of the How Can We Improve the Customer's Experience of Our Life Products paper by the Risk and Customer Outcomes Working Party. This paper has little in it of actuarial theory, but I think it's very important for two reasons. Firstly, our customers need to understand our products. And we either have to explain them better, or we make them simple enough for anyone to understand without a detailed explanation. The depth of understanding is moot. I do not understand how my motor car works, but I still drive it. However, I think we should make an attempt. The second one is the profession has a public interest requirement, and that's pretty core to its message and principles. We need to take a lead in explaining technical issues for the public interest and public good. I'm now going to introduce the opener, Mark Chidley, from the Financial Services Consumer Panel. As a solicitor, Mark specialized in the law of banking and finance. From 2005 to 2015, he was a partner and latterly a consultant with DLA Piper. Mark has a deep understanding of corporate and retail banking and a particular interest to finance in the SME sector. Since 2009, he has been a non-executive director of Northeast Access to Finance Limited, a company closely involved in access to finance issues for small and medium-sized businesses in the northeast of England. Given his legal, banking, and access to finance experience, Mark aims to contribute in particular to the issues facing SMEs as consumer of financial services products, as a member of the Financial Services Consumer Panel. And I'm also sure that he has thought long and hard about how this sort of issue affects retail customers as well. Anyway, Mark.
Steve, thanks very much indeed. And thanks also to the Institute for giving me this opportunity to open proceedings at this sessional event. I'm particularly grateful that the Institute, through this working group, has seen fit to look at the question of improving customer outcomes and the customer experience of life products. Not a lot of people start with the consumer, though when you think about it, businesses probably should, and it's very encouraging when an institute decides to do something like that. I'm also very grateful to the working group itself for coming and talking to my colleague Teresa Fritz and I, both members of the Financial Services Consumer Panel, in particular in relation to the duty of care aspects of the paper, which I'll come on to in a moment. I ought just to say a little bit about the Financial Services Consumer Panel, not least because I think that's my bio from the Financial Services Consumer Panel website, which is not particularly relevant to the proceedings here today. But one of the things that I do at the panel is look at the question of introducing a statutory duty of care to be owed by financial services providers to their customers. As I say, that's something I'll come on to. The Consumer Panel is one of a number of statutory panels which the FCA is required to establish and maintain under the provisions of the Financial Services and Markets Act. We are, however, completely independent from the FCA, and so anything that I say is not a view of the FCA. It is a view of Mark Chidley, and usually it's also a view of the Financial Services Consumer Panel. But we're a very active and possibly occasionally argumentative group of people, so at any one moment I couldn't be absolutely sure. Turning now to the paper itself, it's obviously recently published, so it's not necessary. You want me to stand nearer the microphone? Sorry, right, okay, well, I'm going to move the microphone because I want it to be like. Okay, is that better? Yes, no? That makes it quite difficult to read my notes as well. Is that better? Okay, right. Apologies. If nobody heard any of the rest of what I've said so far, don't worry, it wasn't really worth hearing. Turning now to the paper. First of all, I would encourage you all to look at it. It's a really good piece of work. I really enjoyed reading it. And I think the candour in particular, which it demonstrates in relation to things that have gone wrong in the past, is really refreshing. It's only by understanding all of those things and the things that have gone wrong before that we can have a hope of making things better in the future and addressing this issue of improving customer outcomes. I'm going to focus on 4 particular aspects from the paper: improving customer understanding, needs-based selling, ongoing assessments and wider communication, and then finally the duty of care. Whenever we come and get the opportunity to speak to people, my chairman, Sue Lewis, is always keen that we set the tone by reminding people that being a consumer isn't a job. And I would just ask you to remember that as you go along. Being a consumer is a state. It isn't a job. Okay, starting out then with improving customer understanding. It's very closely linked to disclosure, and the consumer panel is sceptical about disclosure. We think it's a matter of quality, not quantity, and that applies both to the means of presentation as well as the content of information. All consumer journeys, all customer journeys are important, but the paper identifies negative use cases, unhappy consumer journeys, as being really important, identifying what could go wrong. And I think that's a very important component of the work in relation to improving customer understanding. I think I would also like to encourage the working group as it moves forward with this paper to pay attention to the work that's going on in the wider financial advice arena, and in particular the financial advice market review that's recently concluded. Moving on to needs-based selling. Again, the paper is proposing that there is a move away from what industry wants to sell to what consumers need to buy. And I think that's a very important distinction to make. And indeed, I think if it were applied across financial services, it would be revolutionary. But I think a really important point that's made in support of needs-based selling. If that were to happen, it could lead to a new approach to product design. That in turn would promote innovation, which in turn would promote competition, things that are sadly lacking from the wider financial services arena at the moment. And both of them are critical to achieving good consumer outcomes. So once again, well done for identifying those issues. Ongoing assessment and communication. That would follow naturally from needs-based selling. If you've sold a long-term product to somebody because you want to make sure they need it, then from time to time you will need to touch base to make sure it is still an appropriate product. And again, I think there's some good original thinking in the paper about that. Who should be required to take the lead? I think the approach adopted at the moment is a sort of hybrid, with the customer being required to do something and the provider also. I think that's fine, but I do just go back to what I said earlier about being a customer or being a consumer is not a job, and therefore I think there may be slightly more, perhaps a little bit more onus on the provider than perhaps the paper identifies. In that context, I would also like to refer to 2 other pieces of research work that have recently been done. One of them is the role of demand-side remedies in driving effective competition, which is a piece of work that I would encourage everybody to look at. Professor Amelia Fletcher did this work for Which, and though it's primarily driven at competition, it's relevant in a much broader context in terms of looking after the interests of consumers, improving consumer outcomes. And the Consumer Panel will itself very soon be publishing some research that we've had carried out for us by Jonquil Low at the Open University in relation to consumers and competition. And once again, I think these things focus on competition because the Competition and Markets Authority last year did a market investigation into retail banking and SME lending. But there's a lot more wisdom in these papers, and I would commend them both. The duty of care. There is an ongoing debate. The Financial Conduct Authority in its mission is going to, or tells us that it is going to put out a discussion paper. Everything that the FCA says tends to get delayed for one reason or another. They need a new chief executive, or there might be an election, or there might be a Brexit, or indeed, as we learned today, the chairman may be going to move on as well. So there's always an element of delay, and I'm really keen that this debate is kept going by people like the Institute as we wait to see what will happen. For us, the duty of care is not about giving consumers rights of legal redress. It's a tool to improve culture within organisations, to contribute to a re-establishment of financial services firms demonstrating their trustworthiness so that consumers in the market can trust them once again. It's about prevention, not cure. It's about doing the right thing and not spending a fortune on compliance, making sure you're not doing the wrong thing. It's genuinely putting consumers at the heart of a financial services business. I think that's really all I want to say. And again, many thanks for inviting me to make these opening comments. I think it's a really thought-provoking paper. I hope I've identified one or two further issues that can be followed up on in the wider discussion.
Hi. I'm now going to introduce the 4 working party members who will present. There are 2 of them in London, 2 of them are in Munich. There is Tahira Hussain from Vitality. She is the Capital Management Actuary at Vitality. As well as capital and solvency work, Tahira also manages the first-line governance process from a product and actuarial perspective for the actuarial, product and underwriting teams. Tahira has built up a wide range of experience across a comprehensive range of customer-related issues, including 3 years at Standard Life, where Tahira worked within the product compliance team to resolve issues relating to products which impacted customers. Prior to joining Vitality, she spent 5 years working for Willis Towers Watson across a wide range of projects within life insurance, including the normal ones like product development, customer remediation, valuations, and M&As. Kevin Francis, who's also here, is from Capita. He is the MD of Capita's Remediation Service business, which focuses on supporting organisations deal with complaints, past business reviews, and wider rectification issues. Kevin has spent the last 20 years working in the field of remediation. I know what it feels like, Kevin. During which time he has been involved in helping clients with many industry-wide issues across pensions, investments, insurance, and most recently, annuities. Prior to that, Kevin trained as an actuary within the pensions consultancy area, working for Mercer's and Arthur Andersen. The 2 Munich people are Chris Bernard from Allianz. He is a senior actuary with Allianz SE in Munich, Germany, with nearly 25 years' experience in the insurance industry. Chris has worked in the product development, pensions, finance, and business steering areas, with a current focus on customer value initiatives. Chris has held several overseas appointed actuary roles and is a member of the Life Research Committee. Katalin Umanka is also from Allianz. He's an actuarial manager with Allianz in Munich, Germany. Katalin currently works in the product development area with special focus on savings and pension solutions, and also covering other strategic topics such as bancassurance partnerships, customer value, product governance, and business steering. I'll now hand over to them to give their presentation.
Thank you, Steve. Good evening and welcome. It's a pleasure to be presenting here at De Vere Hoban Barnes in London. As Steve has given us a quick intro, so our working party was set up in 2014 to consider how, as an industry, we might avoid some of these historic issues surfacing again in the future. We've been able to draw from a broad range of experience and perspectives, from consulting, research and life insurance. From Chris and Katalin in Germany, who are on the phone, to myself, Tahira and Ihwa, who unfortunately can't be with us this evening. We presented some preliminary thoughts at the 2015 Life Conference and have since then worked on refining the research to a point where we're ready to present our ideas today and start engaging in more formal discussions. So let's start by looking at where things went wrong previously and what may be able to be learnt from some of these. Over the last 20 years, complaints and remediation projects have cost the financial services industry in excess of £40 billion, mainly from the pensions, endowment and PPI mis-selling scandals. This is set to continue to grow, not least until PPI complaints comes to an end in late 2019 as a result of the recent FCA introduction of PPI time barring. Looking back, we can draw a number of common themes out of these mis-selling scandals, which have generally been linked to a predominantly sales-based culture, remuneration of frontline staff that drove inappropriate behaviours, for example, target penetration rates on PPI sales, product design, namely where not all aspects of the product were appropriate for all customers, poor sales practices and processes, and finally, weak regulatory oversight or sanctions. I'm pleased to say that great strides have been made in addressing many of these themes, but have we come far enough as an industry yet to avoid the cost of failure in the future? In the UK, the FCA, in conjunction with product providers, has worked hard to help restore confidence in the financial services marketplace. Improvements have been made, including increased regulatory fines and the extent of enforcement action, although it's pleasing to see a significant reduction in fines in the last 2 years. This is in part due to a greater degree of early intervention, a live example being the outcome of the recent thematic review carried out by the FCA into historical annuity sales practices. This has resulted in several firms now having to undertake proactive backbook reviews of customer sales ahead of complaints coming in. Across the EU, we have also seen positive developments under MiFID, IDD and PRIPS, including aims to improve customer protection in the insurance sector, remuneration aligned to incentivise distributor to act in the best interest of the customer with greater transparency on fees and charges, focus across the whole product lifecycle, including and importantly, ongoing assessment beyond point of sale. However, we still see gaps within the current regulatory framework that have not yet been fully addressed, that include increased focus on requirements to ensure that products on an ongoing basis continue to meet customers' reasonable expectations and provide a fair outcome for those customers. This also includes the introduction of annual statements, including reminder of benefits, options, and any guarantees. The question remains, however, as to who pays for any future advice that is required to ensure that products continue to meet the ongoing needs of a customer as their circumstances change. Furthermore, it's interesting to see that just last month, the FCA announced its findings of its recent review into advice suitability. This showed that whilst rather pleasingly, over 93% of advice was found to be suitable, only in 53% of cases was the level of disclosure associated with the advice deemed to be acceptable. In our opinion, one of the reasons why gaps still remain in the current regulation is that the customer's expectations and outcomes are part of a complex and rapidly changing framework with multiple stakeholders across an often long-term product lifecycle and customer journey. The diagram on this slide here shows a simplified version of this landscape, with our working party views concluding that, firstly, end customers need to be placed at the centre of all stakeholders' actions, behaviours, business models and culture. Products need to be able to evolve to ensure that they remain appropriate as customers' needs change over time. Product design needs to become customer-centric, with customers' views brought into the product design and sales and compliance guidelines. Products need to offer good value for money, whilst remaining simple and easy to explain, with more emphasis on illustrations and what-if scenarios that allow the customer to understand the risks inherent within the products. And finally, the changing regulatory landscape is encouraging needs-based selling and ongoing assessment of product suitability. We now turn our attention to how we may go about improving customer outcomes in the future. Focusing for the time being on the UK, firstly, we would suggest improvements in illustrations that are shared with customers. These include scenarios which need to move to be more forward-looking and regularly reviewed with consideration to interest and inflation and investment returns varying over the product lifetime, including negative as well as positive scenarios. Thought should also be given to the risk-return profile and any link with underlying volatility of the product. The ability for tailoring illustrations to meet specific customer requirements will allow the customer time to interact across a range of scenarios in a dynamic fashion. The next area is needs-based selling, which at the simplest level can be broken down into firstly understanding the customer's value needs. That is, value for money. What is the customer getting in return for their premiums? Do the product features meet the customer's needs in all circumstances? If not, then consideration should be given to rider benefits or optional elements. In some cases, customers should be advised that certain product features would not be appropriate given the customer's circumstances and needs. Stress testing should be carried out to determine circumstances whereby the products fail to meet the needs of the target market. Secondly, understanding customers' risk needs and then ensuring that the customer risk profile or appetite matches that of the product in question. Thirdly, and probably the largest gap currently, is around the ongoing assessment of the product suitability throughout the product lifecycle. This includes monitoring ongoing performance against the initial illustrations and continued assessment of whether the product is still meeting the customer's needs, noting that these may have changed since the point of sale. This also brought us to consider the duty of care, which Mark has already touched on within his opening statement. At this point, I'll hand over to my colleague Tahira, who will summarise the remainder of our paper.
Thanks, Kevin. We'll now consider the implications of our proposals. Improving customer understanding has benefits all around. Up-to-date, clear, and understandable disclosures will improve the customer's ability to select the most appropriate product for their needs. This will also improve the customer's understanding of key product features. There is scope to take this further. Illustrations can be used to define the worst-case scenario. This can be used to take the customer through a journey to explain what could go wrong. It could also provide an idea of which circumstances the particular product would not be suitable. By setting out more information, you're empowering the customer. They can make a more informed decision with the freedom to choose whichever product they wish, and this in itself is a big step forward. Moving on, let's consider the implications of needs-based selling. This is a way of avoiding poor customer outcomes, but this may well have implications for the way the product is sold. it's likely that the market would change. Either it may become more granular to deal with niche groups, or providers may become more selective over the products they offer, or only offer generic products. The other extreme is where providers will unbundle products to match individual specific needs and drive innovation in the market through this. In practice, though, meeting the needs of a customer is likely to be dictated by product features and flexibility. Complex needs often require more complicated solutions, yet products still need to be flexible to meet evolving needs. This challenge should be at the top of any product development and sales capture to ensure we can meet the needs of our customers in the best way. That said, a lot of this depends on the distribution channel and ensuring advisors are on board. This does raise a question, though. What responsibility does the manufacturer have for distributors when following a needs-based selling approach? It's likely that manufacturers will need to step up and be more proactive in monitoring and controlling distribution to ensure the standards are met. We also need to make sure remuneration is appropriate, and we believe that remuneration based solely on sales volumes will be replaced. Rather, incentives will be linked to customer service quality and ensuring needs are met. Ongoing assessments are a key part of the thinking we have done. We believe that one-off, irreversible decisions to buy a product should be avoided. Instead, products should continually meet the needs of the customer, and those needs should be reviewed on a timely basis to ensure the product remains suitable. There needs to be a clear link back to the product development stage. If we don't know our target market and the needs and value proposition are not clearly defined, then it will be near impossible to monitor good outcomes. The responsibility for a regular review and suitability assessment can fall to the company, distributor, or the customer. The working party believes that this burden should be shared between the insurer and the policyholder, and this is an area for further consideration and research. As an industry, we're moving in the right direction, but we can do more, particularly with the advice gap that exists. Mark described the duty of care as an opportunity to ensure firms act with the best interests of customers. Currently, what the industry is missing is a means of demonstrating that we're working with the right intentions, particularly in light of the mis-selling scandals that Kevin mentioned at the start. The ideas behind duty of care are not new, but there are implications. A legal duty of care may appear more onerous, but it may in fact actually reduce legislation. On the other hand, a legal obligation on firms may well reduce product innovation and features and reduce the complexity of products, which in turn would have knock-on effects for customers through limited competition, which would ultimately affect price. There would then be further knock-on effects for the industry and the government, where the protection and savings gap would grow. The government may likely well need to step in to address this. We believe a duty of care will also open up opportunities. Firms can innovate and compete without the unnecessary red tape intended to achieve TCF. It would also introduce a level of trustworthiness in the market, which would lead to greater confidence in our products and opportunities for sales and development. Alternatively, we can choose to extend the Actuaries Code to drive the right behaviours rather than a legal obligation. However, this is definitely an area for future debate and discussion. The consideration of risk and customers is part of a complex landscape with competing interests, functions, and stakeholders. All of these issues are being widely debated within the insurance industry, with the regulator moving us all towards greater transparency with more information for customers. Introducing new regulation may distract firms from creating useful products and may not add enough value for the additional effort. There's a need to balance the impacts on firms, and this debate will keep going for a while. Continuing as we are, though, is not enough either, particularly as we move into a world of more complicated products, where more information may not necessarily solve the issue, that the needs of the customer are not adequately aligned with the products sold. However the industry chooses to proceed, it is clear that ensuring the needs of the customers are met and being able to demonstrate this is a greater area of focus within regulation and one that will benefit us all. We want to make it clear that this is an incredibly complex arena, and while we don't have a magic bullet to solve all of the issues we raise, the ideas we present demonstrate our goal of how customers' understanding and outcomes could be improved. There is no way for the industry to avoid moving forward towards improving customers' experience, and this change should be welcomed and actively embraced. We look forward to continuing to make a contribution in some of the key areas around treatment of customers, value for money, and the concept of duty of care in the near future. The Working Party hopes that the ideas presented today will help firms to take that leap forward. Thank you for your time.
Right. This is where the discussion is now open to the floor. I'm looking forward to an interesting and stimulating debate and would like to encourage as many members who wish to contribute to do so. I always think the most stupid question is always the most interesting, actually, because although it may be stupid, it actually gets to the core of the problem sometimes. May I invite anyone who thinks he or she may wish to contribute to the discussion to let me know of their intention to do so by sticking their hand up. So that's 1, 2, 3, 4. Thank you. A reminder that the meeting is being recorded for publication in the British Actuarial Journal, so please wait until the microphone gets to you before stating your name and then make your contribution. Right, so can we have the first one? Shall we have, sorry, yeah, this one in the front here.
John Spain, first of all, congratulations to the Working Party for daring to take on such a difficult subject. I think everybody in the room probably remembers that wonderful episode of Only Fools and Horses when Del Boy and Rodney became IFAs. And I sometimes feel that they aren't the only ones of their kind. But what surprised me in the paper was, although this evening and in the paper the word innovation is mentioned, there was no mention of insurtech or competition. And yet, in the past, how many life officers are there in the UK? Have there been over the last 30 years? 100? 150 of different sizes, big ones, small ones. You've got the Sun Life ads on daytime TV. Give us 50 quid a week or whatever, and we'll give you £25 back at the end. And people think that is a wonderful deal because you'll get all your money back. The truth is, not only do people not understand guarantees, which are expensive, but also people don't really understand flexibilities, and they are also expensive. So I keep on thinking, are the big profit-making insurers really willing to give up some of that in the hope of keeping some of the customers satisfied in the future? I'd like to think so, but I don't think so. I think competition needs to be reinvigorated. And by the way, I lied earlier. There was no such episode. I wish it had been written, but it wasn't.
Okay. Do you want to answer that about competition?
That's a really great question there. I guess competition is in two parts. On the one hand, companies are trying to generate all this profit, and on the other, you're competing against all sorts of people. You've got new entrants coming into the market. You have to drive something new and make them want your products. I think we've been stuck in a world where people come and they just need life insurance for their mortgage, and we don't think about it much more than that. They get this piece of paper, they put it in their drawer for 20 years and hope that they never have to use it. And that's not really good enough. If we, as an industry, drive innovation, we create great products people actually want, we'll be driving that competition for our own selves. And I think that's the real challenge here. There's a lot of consolidation in the industry already that's been driven through capital primarily. But I think the onus is on each and every one of us to do our part and to take the challenge that we've presented and take that leap forward.
So a concern that, in fact, there is an imbalance between the customer and the provider, so the provider knows far more than the customer. So therefore, competition is always going to be imperfect. And I think that is something that the paper tries to deal with. Okay, next question over there.
Hi there, Tara Burton from Legal & General. You mentioned on one of the slides that there is a need for manufacturers to get more closely involved in the distribution to break down these issues. And I just wondered what kind of ideas and themes you'd explored around that topic.
Another great question. I guess when we were thinking about that, it was more as a manufacturer, you develop this great product, then you put it out there to IFAs to sell, and they may not necessarily be targeting your product at the right people. So it's kind of trying to work out a way of pulling those distributors back into line with the way that you think, and whether that's through in-house sales teams or maybe going out there and training people more and taking more active responsibility, not just throwing commission at the problem, but actually taking a step forward and saying, this is my product, I need to make sure that it's being sold to the right people. And it may be that after you've sold the products that you may do a more after-sales analysis, so maybe looking at the target market that you've actually sold the product to, and seeing how that's working, and maybe then taking a step back and saying, yes, that's right, or not quite, and maybe addressing things that way. But there's lots of things that we can do. I just don't think we're doing enough at the minute.
Okay.
Guys, thank you very much for doing the paper. It's great to see. Sorry, Brandon Horwitz from Vitality.
Thank you.
It's great to see actuaries getting involved in the side of the agenda, and really well done. Just a question about something you said, Tahira, about the burden of ongoing reviews being shared between policyholders and providers. It was a very interesting statement, because I would have thought that they're the two parties least capable of doing an ongoing review. It's a bit like a patient being told, well, why don't you and the drug manufacturer get together to think about whether your drug's right for you? And I always look at the medical model. I would have thought an independent person like a doctor or a pharmacist is far better to do that. Japs, want to pick up on that point and tell us what you were thinking?
Sure. So we introduced this at the LIFE conference a couple of years ago, and we had a bit of a mixed mixed feedback from the crowd. But I guess where we were thinking was that the customers bought something, they need to understand what they've bought and why they've bought it. So there are things that you can do, so maybe prompt them on anniversary statements, so put in paragraphs within the letters saying, do you remember, this is why you bought it? If anything here is different to your current circumstances, come forward. So in that way, the manufacturer is taking that step to tell them what their needs were and why they bought it, and it's then up to the customer to step up and say yes or no. You can't hold the customer's hand for the whole journey, that's unfair. They also need to take some responsibility for what they've bought, but that's going to take time. There's a huge education piece that's just generally missing in society, and that's going to take time to plug. But in the meantime, there are things that we can do, small things. You can make them bigger, but obviously the bigger you go, the more expensive these things are.
Okay, Stuart, down here at the front.
Thank you, Stuart Hicks. I think we need Stuart Hicks. We need to be careful about expecting competition to be the panacea for everything. I think if we look at some other sectors, look at the gas and electricity sector, where the CMA has pushed switching and that sort of thing, and in fact very few people actually switch. And it's easy to switch, and the gas and electricity is the same, so that's pretty simple too. Moving to banking, again, CMA has pushed switching there. Bank accounts are a little more complicated because they've got bells and whistles and so on. Not that many people switch there. So you move into the complicated world of either life and pension savings products, and again, bells and whistles around the place. People don't switch very easily, and price is not very obvious to people either. And that's probably equally true in the GI market, where I think there's evidence that on annual renewal, firms push up the price because they've had low prices the first year to attract new customers. But again, there's a lot of inertia. People don't switch. So I don't think expecting competition to solve the problem is going to do it. Can you explain to me why you think that will be helpful?
Towards the back, can put their hand up originally. Great, Brill.
Hello, I'm Rob Gallagher. I'm currently in another working party which is focusing on the presentation of various risks to a consumer. And on one of the slides that Tahira was presenting earlier, when you referred to disclosures, you drew my attention to presenting what might be the worst case scenario and presenting that to a consumer. I'm interested to find out what your thoughts might be on why that is a good metric and whether that may result in consumers focusing too much on the worst outcome and becoming a bit too risk averse and then just choosing not to buy products altogether.
Well, it's on, yeah. I guess part of the challenge there is if you don't tell them what the worst case scenario might be, and then the worst turns out to happen, you've got a potential mis-scanning scandal on your hands, haven't you? And that costs a lot to put right. So we've seen that in the past, and maybe it's not just around the extremes of scenarios, but the likelihood of those potentially happening. And I think it comes down to informing the customer about what the product does, when it works and when it doesn't work, and then they've got that better understanding rather than being the prophet of doom around a product and scaring them in the first place.
I'd just like to add something to that, and perhaps I'm now speaking with a completely different hat on, which is the purchaser of this kind of long-term protection product. And I think there's a real risk that if I'm shown that it's going to do me 2%, 5% or 8%, then I have limited all of my thinking to an upside potential. So you've got this quite sort of granular upside potential, but no mention other than in the broadest general terms that you might not get your money back of what could go wrong. And I think a little bit more honesty and focus around that. Yes, on the one hand, if you produce bad news to somebody who's about to buy a product, they may just say, no, too difficult, don't want to go there. But I think the paper is trying to suggest a more positive engagement, a more continuous engagement between providers, advisors, and end users or consumers. And it becomes a matter of balance, inevitably. But I think you can't ignore it. And I think at the moment the balance is too much upside and perhaps not quite enough investigation of the sort of negative use case, the negative journey, the unhappy path, whatever you want to call it. And I think it's a brave and good suggestion. And I think most consumer advocates feel that generally, and in financial services in particular, this is an area that needs a little bit more thought.
Kids are now going to have that on them because they have the 4 projections. Not terribly good, what we think is probably likely a really good outcome, and a really appalling stress test outcome. So I think that's the key thing is going to be the wording around that, and also how that's explained to the customer, I think, because it could easily be to ignore all these because just go for the top one. That could be the thing that's explained. Anyway, next question. Anybody want to ask from the room? I've got some I would like to ask myself, but I'm quite happy to wait a second. John's got another one.
First of all, trying to identify the worst case scenario is going to lead to real problems when in fact the worst case turns out to be 2 or 3 times as bad as anybody ever thought, and that can easily happen. Secondly, in DB pensions, which is where I belong, I've come to the view that using discount rates is actually counterproductive. It hides more than it actually shows you. And instead, I'm thinking that what we should be doing is looking at not so much scenario analysis, but what if projections, say 10,000 scenarios based upon robust analysis of what has happened in the past, plus some expert judgment about how that might pan out in the future. And then people...
Kids is trying to do. I don't know if it's going to work, but that's exactly what it's trying to do. You're supposed to actually project 10,000 times and actually come up with what's the mean, what's the high, and what's the low, and so on. I think the problem is the lack of data, and you're using past data to project forward expectations, and I think that's the dangerous side of something like that. That's where the expert judgment comes in. You need some expert judgment to overlay, if interest rates are only going to be 1% for the next 100 years, what does that mean?
It means we're...
Okay, I had a question, but I'll defer here.
My name's David Keeler. Whilst I'm quite supportive of the suggestion that so much information should be available to consumers, I'm actually quite concerned about requiring the industry to provide this information on such a regular basis. I know it happens in quite a few industries. I think the banking industry sends me so many letters. I virtually throw them all straight in the bin. I have stopped working now, and so I have actually, as Stuart suggested, looked at switching energy companies, and I've done it. It is really simple. When I was working, I just didn't think I had the spare time to spend doing that. Now, when people buy our products, there's usually a catalyst for it. They might be buying a house. 5 years later, there may be no such catalyst, and they'll get these letters through the post. How many do you really think are going to be read? And how engaged is that consumer really going to be? I think what we really do need to do here is to have companies that you can actually place your trust in. Now, there are some operating in our market, but as you've highlighted for some of the past scandals, that's not been the case in the past. And we really do need that trust. I think it's very difficult just to impose a duty of care and say, tick, we've done that. The consumer won't actually take any notice of that and think any differently of the industry. You really do need companies that put the consumer at the heart. And as I said, I think there are one or two out there, and they've become very successful.
Do you have any comments?
I'd say I agree.
Okay, I've got a question. Doesn't seem to be any mention of any fundamental consumer research in your paper in terms of actually working out what the consumer wants. I ask this because before coming along here today, I asked my wife, who's a very intelligent woman who never looks at any financial information given to her. She always puts it straight into the bin. But she immediately came up with the top 10 points that are in a KID, believe it or not. She said, I want to know the risk, I want to know what the likely returns are, both at the end and at the thing, and on a bad case and on a really bad case and so on. And I want to know what the remuneration is of everybody involved in selling the plan to me and all the rest of it. She then said something interesting, I also want to know what the impact is on tax and benefits. I want to know, am I going to pay more tax, or am I going to actually lose benefits from actually taking out this product, which I think is not being picked up. I wondered if you'd actually thought of doing any. She also said she wanted it all within 2 pages of A4. Easily absorbed, diagrams, not numbers, she said. But I wondered if you'd actually thought about any fundamental research.
Good point, and we did think about it, and I guess it's part of the consideration of where we move things forward. So, yeah, we were engaging with the Life board to consider whether they would fund some additional research, but we thought we'd bring the paper for discussion at this point first, and and then consider how we take it forward. But absolutely, that was one thing that we were looking to take forward and potentially host. Within provider groups as well, because I'm sure providers have a strong interest in what their customers actually want as well. So it's something that we thought about as a next step.
And there's quite a lot of sort of generic consumer information and research that's already been done. And I'm going to give you this piece of paper on which I wrote down the 2 things that I referred to when I was speaking earlier, because these are, though, as I mentioned at the time, driven by issues relating primarily to competition. They are all about improving a customer experience. So, I think that's a good place to start, and then you've got to get some budget from somewhere.
Gentleman up there.
Gary Yates. A lot of the challenges seem to me quite similar to those faced in general insurance and selling general insurance products as well. So I wonder whether you'd spoken to any actuaries from that function in terms of your research or understanding some of the products and problems.
Not yet, but the issues, you're quite right, across the whole spectrum of the actuarial work that we do, and that's something that we'll look at as part of the next steps.
Just coming back to the previous point about looking at the consumer perspective, you guys may not be aware, but there's another IFOA working group which we started about 2 years ago looking at communicating risk to consumers. So I can pass on the details if you'd like. Gary Smith is currently chairing it, and we've got Bruce Moss involved as well from eValue. So they've actually just got some budgets to go and do some consumer research, which sort of brings me to my final point. It's the so what for actuaries point. So this is a great paper. It brings the question to actuaries, but what can we do? And the challenge I'd give all of us is, so if we're so good at quantitative things and communicating risk and making financial sense of the future, how do we produce this miraculous 2-page paper with diagrams and not one mention of the word volatility and standard deviation? So I'd be interested in the panel's view of what can we as individual actuaries in our jobs do. And again, if you need any help, I can connect you to Gary Smith, but the IFOA central team will be able to connect your working party to theirs.
I had one question, which was about remuneration. How do you measure customer service quality and ensuring needs are met? Especially if people are then going to start suing you for missing their bonus. For a chief executive, that might be a lot of money, so it might be worth him employing a very good lawyer.
So one of the things I see quite frequently in my job is the complaints that come through. They cover a wide spectrum, but it's generally a complaint because we as a firm haven't met the expectations of a customer and their journey hasn't been what they wanted it to be. So I guess if we're driving remuneration through ensuring good customer service, in turn we're going to reduce the number of complaints, we're going to reduce the amount that we're paying out through redress, and hopefully improve the general opinion of our industry, and that can only have advantages.
Okay. Any way of measuring positive? Any way of measuring positives as opposed to measuring negatives? But that needs to be done. That work needs to be done.
I guess people are more likely to step up if they've had a bad experience. But you could maybe actively go out there after a sale and try and get some research or do a little survey and try and get some feedback that way.
Okay. One other question I've got is, what is risk? I know that sounds a bit odd, but PRIPS suggests that risk is measured at the point of the assumed holding period. So you don't bother about what happens in between. But customers, I think, have a very different view, and IFAs have an even more different view. What do you think we should be defining risk as for the purposes of these long-term financial products?
I guess from my perspective, it's about, does the product perform as expected in the consumer's eyes? That and what's the likelihood of it not performing, and if it doesn't perform, what does that mean for me as an end consumer? That's the angle I'd put on it, very much from the customer's perception, because they don't understand things like volatility and that sort of terminology. Is this product I'm paying premiums into going to deliver the benefits I expect at the point I need it?
So my name is Alice Hutchinson. Just two quick comments, really. So firstly, the question that the gentleman to my left asked about whether there are things that, as individuals, as actuaries, we can do. I'd be interested to know if you do have any comments on that specific question. And then I also wanted to ask, so one of the comments that sort of seem to keep coming up, and that we've also mentioned from the floor as well, is about how maybe there's a bit of a gap in sort of maybe what policyholders or what they expect from the products, I guess. And so my question is there a place maybe for the Institute or for other non-company players, maybe the regulator, to be involved in sort of educating the public more generally, rather than it just falling to the responsibility of companies in terms of educating people more generally on what kind of things they should be looking for when they buy products, what questions they should be asking?
Well, I'll have a go at the second question because I'm afraid I'm not an actuary and I'm not quite sure what actuaries can do. If they're going to try and keep it down to 2 pages, don't involve a lawyer. That's the only piece of advice I would give, because they charge even more for abbreviating things than for the long documents. Sorry, apologies to any other lawyers. I've sort of retired from being a lawyer, so I regard lawyers as now the butt of the occasional joke at this part of the proceedings. I think you suggested, might the regulator get involved in education? And I'm pretty certain that if I was representing the FCA, which I'm not, I would say that I am a principles-based conduct regulator, and that is not really any part of my remit. And I think that's a perfectly legitimate point for them to make. However, education is really critical. And the point that I'm just going to read briefly from the sort of implications section here. So I'm speaking on behalf of the working group. We also believe that at some point the customer has to take responsibility for ensuring the product is understood and suitable. Education is key. Absolutely it is. And I also just want to make the point that the consumer panel equally agrees that there is a point when actually the customer has to get off the fence and make his decision. And that already, there is a principle to that effect. It's one of the principles of good regulation that customers take responsibility for their decisions. However, I must also say that as the consumer panel, we take the view that you can't expect consumers to be able to do that unless the people providing them with the product have exercised a duty of care towards them in terms of making sure that it's suitable, explaining it properly, and so on and so forth. So at the moment, I think there is a role that it's hard for the financial services industry to get away from. However, broader issues of financial literacy are absolutely crucial, and it requires a more significant level of financial literacy to be dealing with more complex products such as life assurance than it does to be thinking about a bank account or a simple loan or whatever else it might be. So not a satisfactory answer to your good question, but I think that's probably an analysis as I see it at the moment. Are you going to deal with the actuary's question?
I think that's one for Chris and Kathleen.
Yes, from our point of view, we think that education is key for consumers. We don't have any thoughts at the moment on how actuaries can get more involved in doing that. We think this is a wider issue than just the actuarial profession, and we think it has to start at a younger age, perhaps when people are even in school. I learned everything at school from Fibonacci numbers to finger painting, but no one ever taught me what a bank account was or how interest rates worked. So I think this is a countrywide and issue, and I think it should be remediated at an early level. As actuaries, we have our individual duties to educate people where we can, but I'm not sure I thought of a role yet for the actuarial profession in this arena. Kathleen?
No, I would agree as well.
Yeah.
Okay. We haven't really tackled anything about the advice gap. Do we think, as a profession, that actually advice is affordable all the way down the premium scale? Do we believe that people who are contributing, say, only £100 a month can actually afford advice at all? Or whether, in fact, for them, it's better to buy simple products with low risk attached to them that they can actually be safely buying without too much thought?
I think that's an excellent question. If I'm correct, are we in a building which is somehow associated with the Pru? Is that true? This was the Pru. So very appropriate, because I was discussing this with a colleague the other day, and I'm far too young to remember the man from the Pru, but I've certainly read about the man from the Pru. And the question is it time to bring him back, or her, as the case may be? Because for those who don't remember, and I certainly don't, but apparently he or she, it was a he, let's not kid, would knock on your door and sell you a policy for a certain amount of pounds a month, and this would be an insurance policy, an investment policy. And the important thing is it was aimed at the mass market. Somebody would save. The policies probably were not the most value for money for customers in the world. They probably had a decent margin for the insurance company, but the insurance company was funding this person who was knocking on the door, sitting down and having a cup of tea. And I'm going to turn my question on its head and say again, is there now maybe this duty of care for the insurers, for the providers, to reinvent their sales forces And dare we challenge the regulator and say, well, perhaps we should find a way to remunerate them for how many products they sell, and perhaps that will close the gap?
I would like to say, too, that my sister, for the first 10 years of her married life, bought everything from the man from the Pearl. Household insurance, motor insurance, life insurance, the lot, because he was a nice guy who came round, and if she ever had a claim, he made sure it was paid. As far as she was concerned, that was worth paying a little bit extra for.
I was just going to add, I think the man from the proof stopped because that particular company worked out that it was actually costing more than literally the premiums they were getting in. And there was genuine discussion, I think, that took place with customers to say, look, you can have your benefits, we're just not coming to collect the premiums anymore.
Yeah.
But interestingly, though, to your point, a lot of customers said, no, I'd rather pay the premium and have the person come, because, so customers were they weren't valuing it as a service to come and collect premiums. They were valuing it, okay, sometimes just someone to pop round and have a cup of tea, but sometimes, as you say, because they wanted a bit of financial advice. So, yeah.
We'll wait for the mic. Otherwise, I'll get into so much trouble.
Here's a really radical idea. Given that we have a serious issue with care in this country and the government trying to think about what they're going to do for care, perhaps we'll combine, your insurance collection and care, and all these lonely people will get both. We can sort out the government. Somebody call the Tories.
John had a point.
I like that. The Prudential was one of the biggest players in what was called industrial branch insurance, where people went round collecting an old penny a week, or even a big one, tuppence a week, old pennies, and the premiums could not be collected more often than every 2 months, I think it was. From the proceeds of all of that, the Pru basically built this beautiful building. The Pearl up the road, it's now a hotel, have the most beautiful marble staircase paid for from policies which cost a penny a week. The profit margins must have been pretty damn good. I've never seen the Britannic building in Birmingham, but I imagine it's something similar. There was a lot of money in that. It's not there anymore. But can I just go back to this thing about flexibilities? Think about a 10-year policy. It costs if things don't work out. What's going to happen after, say, 5 years on average is going to be quite different to what happens after 10 years or 15 years. Path dependence is really important. The punter has to have it explained that do you remember surrender value penalties? You promised to pay us for 15 years and you haven't done so, and therefore we're going to give you a lot less than you paid in. That was the reality. And flexibilities cannot be built in unless they're going to be paid for in advance, which is going to reduce the amount available for longer term investment. Actuaries should be explaining to clients, whether it's their employers, their sales force, or the customers at the end, that we're looking beyond, not just at now, and they've got to do the same thing. Flexibilities sound great, but I don't think they're really deliverable in terms of reasonable policyholders' expectations.
Respond to the cost of flexibility.
Yeah. I think there's a distinction between thinking of flexibility in terms of customers' needs and flexibility as a guarantee. I think where we were coming from as a working party is that in 5 years' time, I have no idea what my life is going to look like. And so my needs will be very different. So we can either attempt to produce really short-term products, say 5 years with mandatory reviews, or we can maybe go the other extreme and come up with something more generic, perhaps a unit-linked product, and you change your benefits according to your needs at that time. So there are things that we can do in the industry without impacting profitability and without tying ourselves in as a company. I think we just need to think bigger. We're moving into a new generation of consumers, those who want information instantly. They want to be able to do whatever they want at any time they want. And we need to we need to be flexible within our own selves as well, and to be able to cope with future demands. So it's not just about guarantees and being able to think of every scenario. It's about offering a product where we can give the customer the right thing at the right time.
Are there any more contributions from the floor? One more. That's the last one.
Hello, Jug Parmar. Mostly I want to pick up on other comments. Insurance, life insurance, long-term products, they're incredibly complex and various. The original contribution referred to InsurTech, and certainly, there's an appetite to invest here. And where this is starting is typically very simple to transact business, so something that you can do on your mobile phone in a matter of seconds. And in this instance, ease of use is great and cover is great, but value for money probably isn't, and the consumer isn't really bothered about that. So is that an issue? What we as a profession are perhaps, or what we're very good at, as the numbers and the technical stuff, what we tend to not think about very hard are the emotional aspects of decision making. Tying this into the question about how you measure customer service, customer experience, very often what you feel emotionally in a transaction or a purchase decides how well you thought that went. So if I'm buying a car and somebody is being very complimentary to me, they may well sell me a car which is a lot more than I want to spend, but that good feeling will make me think that actually that was a good sales process. And in an insurance situation, it may well be that when I purchase a mortgage, an advisor may well say, well, a very real risk is if you're made redundant, you may well have your policy invalidated through not being able to pay your premium. So my advice would be take out a rider for redundancy cover. And for me, that may well sound fantastic at the time, and I'll give great feedback. But a few years down the line, when that situation occurs and I find that actually the terms and conditions show that for me that wasn't appropriate, it's a little bit too late to go back and revise that customer feedback. And coming back to this contribution over here, trust really is a big thing. And with reference to the man from the Peru, I worked in the Indian reinsurance sector for a number of years, and they're by far the biggest life insurance company, which was the state monopoly, although it is very much a private insurance market now, has a vast sales force. You're talking about millions of people. And very much of this is trust-based selling. So the people selling are quite typically somebody in your family. It's a part-time thing that they do. But it's all about knowing who that person is and being able to trust them. If there is a question, I would really ask to what extent do you consider the sort of emotional aspects of transacting and just how difficult that makes really sort of measuring and changing things for the better.
I think this is normally all summed up in behavioural economics and the fact that people do not want to admit they made a mistake when they buy something. So, so I wondered if you wanted to give a quick response to that. Leave that one blank. Okay, thank you very much. Okay, that brings the discussion to an end. I'm going to now Sorry, I'm now going to introduce the closer, Paul Fucher from Nomura. He is the head of ALM structuring for Nomura International PLC, and he's responsible for delivering Solvency II ALM and capital market solutions to insurers across Europe. There's nothing like a good acronym, is there? In his professional capacity, he chairs the Life Research Committee, and he is also a member of the Life Board. Paul.
The second half of my CV there is slightly more relevant for this discussion maybe than the first. Yes, as chair of the Life Research Committee, we commissioned this working party, I think in 2014, 3 years ago. As I think the very first speaker said, they took on a very large task. So I think the first thing I'd like to do is just thank them on behalf of Life Board and the Life Research Committee. There was a lot of very difficult questions for them to answer. I don't think they've necessarily come up with the answers, all of them. I think they wouldn't say they have. It's ongoing work. But they've certainly posed some important questions and made some very good suggestions for things to take forward. I think it's also worth saying, and Brandon's already mentioned it, and Rob Gallagher in the audience as well, the profession has a number of other working parties looking at consumer areas. As a profession, we aren't always as joined up in our research as we should be. It probably shouldn't be news to the people up the front that both of those working parties exist. It worryingly probably was. But just to highlight the sort of work that the profession is doing, we've got working parties looking at the impact of the low rate environment and Solvency II, and the ability of customers to, or the ability of product providers to offer guarantees at a cost that customers will pay. We've got another group looking at sort of consumers and their understanding and experience of with profits. We shouldn't think entirely of, the new products we're selling to new customers. We have legacy customers with legacy products. We've got a putative group looking at financial literacy, which was a topic that came up a couple of times in the discussion and is mentioned in 6.2 of the paper. And perhaps most pertinently, Rob's working party, the Consumer Risk Metrics Working Party, which is about to launch a survey actually of customers, so via an external survey firm, and they're trying to understand a little bit how customers measure risk. What sort of metrics or what risks does a customer think of as the risk of his or her product when they buy it? It might not be reduction in yield, it might not be value for money, it might be something else altogether. Does it pay out when they need it? How flexible is it? And we're trying to get some understanding of what those are, and then how, given some of the earlier discussion, you can translate that into metrics that we can communicate to people. So this is a big area of focus for the profession. I'd encourage everyone in this room to sort of carry on joining in the debates, coming to the meetings, the sessional meetings, feeding into the research that's being done. In terms of the discussion tonight, I think the only comment I would make is that I found it sort of very salutary and a little bit depressing in a way that the paper points out that almost exactly 20 years ago, Jeremy Goford, who was, to be fair, an actuary ahead of his time, but maybe not that far ahead of his time, was making a lot of the same points about needs-based selling that we're still talking about 20 years later as something we should be trying to do. I think salutary in the sense it shows these things aren't always that easy. And just to give an example there, which again came up a little bit in the discussion, we talked about product flexibility and maybe the ability to add riders onto products. In terms of things like value for money, certainly in my experience of, say, the Asian insurance market, is that it's often those riders that are added onto products that are probably the least value for money in terms of what the customer pays for the rider versus what it really costs to provide and the claims they get. Arguably, PPI was a rider, as someone said earlier. So that's not to say that's not a way to go, but again, these are all sort of, it's a complex topic, and we need to move in sort of in baby steps, I guess. In terms of the discussion itself, I thought there was a few interesting points. Brandon's point about the debate between whether consumer or the provider should be the one who bears the burden of ongoing review. I thought it was a very great line. Well, they're probably the least two qualified people to do it. Maybe there is a need for some sort of ongoing review process independently. I think there was quite an interesting debate about the role of competition. Does InsurTech help? Is competition the right thing? But someone else said it's not a panacea. I think some interesting debates which again feed into the research that's being done about risk metrics. I think 2 or 3 people in the room said that worst case didn't sound like a great risk metric. It might put people off. It might well turn out that, it may well be a famous last words saying that was the worst case scenario, because chances are it won't be. But then what is the way of measuring risk? Again, someone else, I think, made the interesting point at the end, that value for money might not actually be that important to consumers compared to other metrics. I think the need for consumer research came up, and again, that's something I think as Lifeboard will need to consider whether we want to fund. I think, as I said, we're already commissioning 2 pieces of research on the with-profit side and the risk metrics side. So again, that is an area where we are keen to sort of concentrate attention and funds. And then perhaps the one thing, if you like, the dog that didn't bark, I think probably the Working Party are expecting more discussion on duty of care, actually. Probably what they thought was one of the more controversial topics that was raised. Didn't really come up that much in the debate, although I think David made the very good point that perhaps just imposing, David Keeler, just imposing a duty of care on people isn't sufficient. We really need a sort of customers that actually genuinely put the customer at the heart of what they do, rather than actually just doing it because they're told to by someone. Although, to be fair, I think to Mark and the Financial Services Consumer Panel, I think that's pretty much exactly what you mean. You don't see duty of care as being a way of people being able to sue people in a box-ticking exercise. It is around a change of culture. But I think that duty of care debate, maybe we didn't have it today, but I think we'll hopefully have it going forward. And I think that's very much it from my side. Thank you very much. I'll hand over to Steve to close things off.
Thanks, Paul. I'm not going to do what it says here, which is summarise the discussion, because I think Paul's done that brilliantly. Instead, I'm going to say just that it remains to me to express my own thanks, and I'm sure the thanks of all of us, the authors, opener and closer, and all those who participated in this evening's discussion. It has been quite a good discussion, and I think it's opened up some things. I think it would have been useful, as Paul said, if the duty of care bit had been prized open a bit more, but never mind. It would also be very helpful for those preparing the transcript of the discussion for the British Actuarial Journal if you could hand in any prepared notes to the members of the events team on the way out at the back of the hall as you leave the meeting, because that helps them make sure they understand the question you are asking. Anyway, thank you very much for coming. I'd like to express my thanks, which I'm sure you're going to make in the normal way, to the paper and the openers and the closers.